Have you ever wondered how investing works? Or perhaps, what it really means to place your money in the hands of the stock market, real estate, or a business venture? Welcome to the fascinating world of investing, a realm that goes beyond just the hope of making money. Investing, in essence, is about putting your money to work. It's about making informed decisions and understanding the risks involved. It's about allowing your money to grow over time, to build wealth rather than just accumulate it. But it's not a get-rich-quick scheme. It's a long-term commitment that requires patience, discipline, and a keen understanding of the financial landscape. Yes, there are highs and lows, gains and losses, but that's all part of the journey, a journey that can lead to financial freedom and stability. So, ready to embark on this exciting expedition? Remember, investing is a journey, not a destination, and every journey begins with a single step. So, you might ask, why should someone consider investing? Well, let's break it down. Think of investing as a journey towards financial growth and security. It's like planting a seed and nurturing it over time. As the seed grows into a tree, it bears fruit. These are your returns. The power of investing lies in its potential for returns. When you invest, your money works for you, generating more money. This is what we call the magic of compounding. With time, even small amounts invested can grow into substantial sums. But investing isn't just about making money, it's also about financial planning. It's a vital component of a well-rounded financial plan, helping you to achieve your financial goals, whether it's buying a house, funding your child's education, or preparing for retirement. Remember, investing isn't just about becoming rich. It's about creating a secure future. So why not start your investment journey today? Now, we need to talk about a crucial element of investing: risk. The word risk might make you think of danger, hazard, or even loss, and in the world of investing, you're not completely off the mark. Risk refers to the potential that your investment may not pan out as expected. It's the possibility that you might not get your original investment back, or that you won't earn the returns you hoped for. But here's the twist: risk is not necessarily a bad thing. In fact, it's an inherent part of investing. Without risk, there would be no potential for reward. Think of it this way: if you're running a race, there's a risk you might not win. But if you don't run at all, there's no chance of winning either. Similarly, in investing, taking on some level of risk can open the door to potential returns. This is often referred to as the risk-return trade-off. Generally, the higher the potential return, the higher the risk. And conversely, investments with lower risks typically offer lower returns. So, how can we handle risk? One key strategy is diversification. By spreading your investments across different types of assets, you can potentially reduce the impact of a poor-performing investment. It's like not putting all your eggs in one basket. Another important aspect is understanding your risk tolerance. This is a personal measure of how much risk you're comfortable with. Are you willing to take big risks for potentially big rewards? Or would you prefer to play it safe, even if it means potentially lower returns? Remember, there's no right or wrong answer here. It all depends on your personal circumstances, financial goals, and comfort level with risk. And finally, always keep in mind that while risk can't be completely eliminated, it can be managed. By understanding risk, diversifying your investments, and knowing your risk tolerance, you can make more informed investment decisions. Remember, risk is a part of investing, but understanding and managing it can help you on your journey. There are many ways to invest your money. Let's delve into some of the most common types of investments. First up, we have stocks. Stocks represent ownership in a company. When you buy shares of a company's stock, you effectively become a part owner of that company. This means you may be entitled to a portion of the company's profits in the form of dividends. The price of a stock can rise or fall based on numerous factors, including the company's performance, economic conditions, and market sentiment. Next, we have bonds. Bonds are essentially loans that you give to a corporation or government. In exchange for your loan, the issuer of the bond promises to pay you back the principal amount plus interest over a specified period of time. Bonds are generally considered less risky than stocks, but they also typically offer lower returns. Now let's talk about real estate. Investing in real estate involves purchasing properties for the purpose of generating income, either through rental income or through selling the property at a profit. Real estate can be a great way to generate passive income and build wealth over time. However, it requires significant capital and can be risky if property values decline or if you can't find tenants. Then we have mutual funds. These are investment vehicles that pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other assets. Mutual funds offer a way for individual investors to gain exposure to a broad range of investments without having to buy each one individually. They are managed by professional fund managers who make the investment decisions. Finally, there are many other types of investments out there, including commodities, options, ETFs, and even cryptocurrencies. Each comes with its own set of potential returns and risks, and it's important to understand these before diving in. Different investments offer different potential returns and risks, and understanding them is key to building a diversified portfolio. Now that we understand what investing is, why it's important, and the basics of risk and types of investments, we can talk about how to actually start investing. The first step to start investing is to set clear financial goals. Are you investing for retirement, a new home, your child's education, or perhaps a trip around the world? Identifying your goals will help you understand how much you need to invest and the level of risk you're willing to accept. Remember, every journey begins with a destination in mind. Next, you'll need to create a budget. This is a crucial step many overlook, but it's essential to know how much you can afford to invest without compromising your daily needs. The key is to find the balance between living comfortably today and securing a prosperous future. Once you have your budget, it's time to build an emergency fund. This is a safety net of cash set aside to cover unexpected expenses or financial emergencies. It should be enough to cover 3 to 6 months of living expenses. This fund ensures you won't have to dip into your investments when life throws a curveball. Now, let's talk about choosing your investments. There's a wide array of options: stocks, bonds, mutual funds, exchange-traded funds, and more. Each comes with its own set of risks and rewards. Your choice should align with your financial goals, risk tolerance, and investment timeline. Diversification is vital here. By spreading your investments across different asset classes, you can manage risk and potentially increase your chances of return. Once you've chosen your investments, it's time to decide where to buy them. You could go through a traditional brokerage, an online platform, or a robo-advisor. Each has its own advantages and disadvantages, so do your research and pick the one that suits your needs best. The final step is monitoring your portfolio. Investing isn't a set-it-and-forget-it game. The market changes, and so do your financial circumstances. Regularly reviewing your portfolio allows you to adjust your investments to align with your current goals and market conditions. But remember, investing is a long-term game, so avoid making hasty decisions based on short-term market fluctuations. And there you have it. 6 steps to start your investing journey: setting financial goals, creating a budget, building an emergency fund, choosing your investments, deciding where to buy them, and monitoring your portfolio. While it may seem complex, take it one step at a time, and remember, every investor started where you are right now. Starting to invest might seem daunting, but with knowledge and a plan, you can embark on your investing journey with confidence. We've covered a lot of ground today, so let's take a moment to recap. From understanding why investing is key to building wealth, to breaking down the concept of risk, we've explored some of the fundamental aspects of investing. We've also delved into the different types of investments available, from stocks and bonds to real estate and mutual funds. And most importantly, we've discussed how to take that first crucial step into the world of investing. Remember, it starts with setting clear financial goals, researching your options, and making informed decisions. And don't forget, you don't have to go it alone. There are resources and professionals out there who can help guide you on your investment journey. Investing is a powerful tool for building wealth and securing your financial future. Remember, knowledge is power. Happy investing.